Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news with our Bloomberg Intelligence analysts all around the world. They cover 2,000 companies and 130 industries. And we also tap our amazing Bloomberg News team who are deep in the weeds of everything you need to know in all the market action. And one of them is Bailey Lipschultz. He's been very busy. He had to actually cancel radio hosting yesterday.
I left Carol hanging and I haven't apologized.
Because of the meme stock craze.
I know. I still
You have a day
feel bad.
job. It's cool.
Yeah.
It's cool. So we know the meme stocks did some stuff for 3 days and they rallied and they're giving back a little bit today. Did any of them issue shares or anything and take advantage of this?
So AMC had what we call an at-the-market offering that was approved back in March. That enabled them to sell shares at the market, have their bankers just keep pumping and creating shares to raise up to $250 million as fast or as slow as they would want. They did about half of that prior to the Mania and announced on Monday that they completed that, so raised another $125 million on the back of Monday's what turned into a 78% pop for the shares. Then today, they announced plans to do a debt for equity swap. So swap out some debt. Your debt holders now become equity holders. You create more of those shares, all to try to address the fact that they have a few $1 billion on their debt load, most of that due in 2026. So the company has said they're actively talking to lenders to try to work on addressing those issues.
AMC Entertainment, all right, it's down 20% today, but just about $1 billion of stock has traded today. I mean, this isn't pennies. This is real. And money, when it goes back to my thing, like, who's trading this stuff?
And that's what we wrote in my view, a good story, because obviously I wrote it.
You.
But we wrote a story yesterday that kind of dove into the fact that when I talk to people who advise hedge funds, these momentum quants have gotten more sophisticated, caught on to the playbook from 2021, and are buying and selling and trading these shares. So helping create that big rally we saw Monday and Tuesday, and likely getting out of the stock, whether they're in the trade for 2 minutes or 3 days. They buy when stocks are going up and then they quickly sell. And the whole goal is to, as we wrote, basically, in a way, front run retail.
Mm-hmm. Whoa. I'm looking at is this right? AMC Entertainment's got $9 billion of debt?
That includes their leases.
So
call it 4.5. 4.5.
But still, they have...
It's sizable. Relative to their cash is...
Rise. I'm looking at EBITDA. Let's just take 2025's estimates, 500 million. So still 10 times levered. Again, having banked these guys in the past, 4 times is the multiple, is the leverage I would put on this thing. Maybe if the sub guys want to go above it, that's their business. But crazy. But at least AMC's trying to.
Yeah, I was going to say, but don't we like the fact that the CFO is like, guys, let's do this, right? That's a good thing.
It's a good thing.
And that was part of it, right? So a few years ago, they created these 8 preferred shares because they couldn't get approval from investors to sell more shares, because you have to get approval to create more shares, to expand the number of shares you can have outstanding. Right now, according to B. Riley's Eric Wold, he estimates the company still has 191 million common shares authorized but not yet issued. So they can hit another ATM, or they can continue to do some of these debt swap deals to try to address, again, the fact that they have a lot of debt and they have a lot of near-term debt. And Paul, as you mentioned, the underlying business is not really doing a whole lot.
Yeah, you think about the theater business, it goes to the fundamentals of post-pandemic. What's the demand for movies in theaters? And it is less. But it is still there. Probably the bigger issue, if you ask the theater owners today, is it's just not a lot of movies, and that was in large part because of the writer's strike and the actor's strike pushed everything back about a year. And then you've had some decisions by Disney saying, you know what, we probably are overplaying our Marvel stuff, our Star Wars stuff, putting it too close together. Let's spread that out. So stuff that was going to be in 24 is in 25. 25 is going to be in 26. So you put all that together, and if you're a theater owner, you're like, I ain't got that much to put in my theaters.
When's the last time you saw a movie in the theaters?
In the last few months.
Yeah.
Okay. A couple weeks ago, I saw Dune 2.
Ooh.
Yeah. Well, I like going to the Nighthawk in Brooklyn where they have like drinks and food and they bring to your seat. Like, I like the whole experience. Like, I don't go to a straight up AMC and just eat regular popcorn. anymore. So I do the whole, it's cheaper than going out to dinner. Like you can spend like $120, you see movies, you have dinner, you got drinks, you got dessert, versus going and spending $300 at like getting pasta.
And that's been the big
Prosecco, though.
You can get a Prosecco at the
that's
the
been
movie
the big
theater.
pitch
That's
for
the whole
AMC.
point.
They want to they want to elevate it, so they're making more money in terms of margins expanded on people.
Isn't that like distracting though? You know, everybody's chewing and eating while you're trying to watch a movie.
No, they're doing it anyway if they're eating popcorn and stuff. No, it's actually, you get used to it. It's totally fine.
The seats are awesome. I will
really
say,
nice.
I saw a movie on Friday, I think, and the layback seats. I'd never been to a luxury movie theater, and you're like, wow, I'm laying completely horizontal watching a movie. This is awesome.
And the thing is, you know, if you're a movie theater, the economics of a movie theater is you don't make really anything on the ticket sales, or as much, because you have to give half to the studio. Where you make it is in the popcorn and that's all your margin right there.
Or the Prosecco.
So the more you get,
brownie sundae.
Exactly. So
nice
the more,
kale salad.
and you know, they've been giving you crap for 100 years.
Yeah.
You know, they're just finally waking up that if I really want to get that person off the couch in front of their 80-inch TV and the surround sound, I got to up my game a little bit.
Truffle salt butter popcorn. I'm going to drop that right there. It's just beautiful. Okay, before we let you go, what is the downside, you think? Can we unwind all of the last 3 days, or what do you think?
Probably. I mean, if you look at
fundamental... As in, like, why not?
Well, what has changed fundamentally today versus a week ago, realistically, versus 3 months ago? Nothing, really. And that's been the whole argument when we saw the big rally, both stocks up more than 70% on Monday, all on the back of the Roaring Kitty post on Sunday evening, is that really was just kind of like the match to get people back out and trading this. It didn't actually change things. And one of the things that I think is worth pointing out is the difference between now and 2021 is people were buying stocks for the first time in 2021. The stock had already jumped, 500% before a lot of retail investors downloaded Robinhood, found out how to fund it and buy call options. People have been holding these stocks for a long time and are sitting on massive losses that if you see it go from 16 to 50 and I got in at 45, I might as well at least have some kind of gain as opposed to waiting around forever.
All right, good stuff. Bailey Lipschultz, Equities Reporter, Bloomberg News, joining us here in our Bloomberg Interactive Broker Studio. You mentioned, what kind of pop salt do you like?
Oh, truffle.
Have you ever gone truffle hunting?
No.
I've gone truffle hunting in the south of France. How about
with
that?
With a pig or a dog? Or?
They usually do pigs, but the smart ones use dogs because the pigs will sometimes eat the truffle. The dogs, you can train them not to eat the truffle. So they sniff around underground.
Oh my gosh.
They start digging. You pull the dog away, and then you dig them out. They're right under the surface. Thank you to Keith Grossman, our former head of ad sales at Bloomberg, who arranged these lovely outings 2 summers in a row. A complete crazy bacchanal in south of France. It was great.
And then do you like take the truffle? You can't take the truffles home, like to the U.S., but you like.
I don't know. I hate truffles. I'm not in truffles. So everything they have truffles. Yeah. Then they have this little store and this little farm. I'm still on the mailing list, and they have a nice little French people, young couple, and they have a little French truffle thing going on.
I love this for me.
It's another trip.
A little rosé with that.
Oh my gosh.
To die for it in the in May or
Sold
June.
me.
So that's next on the docket.
I love all of this. I'm going to ruminate on this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get to some of that economic data here today. Lydia Boussour joins us. She's a senior economist at Ernst Young. She joins us from New York City via that Zoom thing. So, Lydia, looks like that inflation scare that we had maybe the first 3-4 months of this year is maybe moderating a little bit. Is that the takeaway from the CPI data that you looked at today?
Yeah, sure. I mean, I think the key takeaway is really that inflation continues to move in the right direction, and that this inflation trend remains in place despite the bumpiness that we had in the first quarter. I think the details of the report this morning were encouraging, both on the goods and services side. We saw that cooling in core inflation, core goods prices declined in April, and that really indicates that this more favorable and normalized supply chain environment continues to be conducive of deflation in the goods sector. And on the services side, we also saw an easing in the pace of inflation, with many of the categories also showing some cooling. Mm-hmm. So overall, that's a report that suggests that we're still moving in the right direction.
Something I'm still grappling with is why the Fed has such conviction that financial conditions are tight. When you take a look at meme stocks, when you take a look at the actual financial conditions index, do these numbers justify that confidence or no?
When we look at the economy overall and the package of economic data that we got this morning, you mentioned retail sales earlier on the show. Retail sales were quite soft, and they do suggest that consumers are increasingly cautious with their spending. We have an economic environment that's cooling, the labor market is rebalancing, wages are moderating, and at the same time, we have, today some evidence that we remain and we continue to see that disinflation happening, especially on the core side. So the progress has been slower, but overall, the economy continues to cool, and inflation is likely to continue to gradually ease, throughout the 2024 and towards 2025. I think what will be what's important to keep in mind is that we may hit a plateau when it comes to inflation, CPI inflation, in the coming months. But overall, I think the report today has helped rebuild a bit of confidence that the Fed had lost in the first quarter of the year.
Lydia, we also yesterday had a little bit higher than expected PPI print. How do you kind of put that and the CPI data we got today? How do you put that together? What's the narrative there?
Yeah, I mean, looking at the PPI data, I think some of the details were more encouraging, especially looking at some of the key categories that would feed into the PCE data. So looking at some of the underlying components of PPI. But overall, I think when we look at the overall trend in inflation and what that means, also looking at these two reports for PCE inflation, I think that we're likely to get a fairly encouraging print on the core PCE data, and that overall core PCE inflation should continue to gradually ease in the coming months. I think we're coming off of that first quarter where inflation has surprised on the upside, for several months. And what we need to see going forward is really softer inflation print, a string of softer inflation print that will help the Fed feel more confident that they're in a good spot and can start that easing cycle.
Do you think the easing cycle will be 2 cuts this year, 1, and then what?
Yeah, so we have our view is that we're going to get 2 cuts in the second half of this year. We do think that as I said, the economic environment will be favorable for those 2 rate cuts. And when you think back at what Fed Chair Powell said at the press conference, he really laid out 3 paths when it comes to monetary policy going forward. And there are 2 of these paths that are leading to rate cuts. If you see a deterioration in labor market conditions, or if you see inflation moving sustainably towards 2%. Our view is that the economy is going to continue to cool, and that conditions are in place to continue to see that disinflation. We have an economy that's cooling and consumers that are growing increasingly cautious. We have a labor market that's rebalancing and wages that are easing. We also have signs that companies are exercising less pricing power, and we're likely to see more downward pressure on profit margins as well. And lastly, we also have more rent disinflation in the pipeline, and the numbers this morning were also encouraging in that front, where we continue to see that downtrend in rent inflation. So overall, I do think that this backdrop is going to lead the Fed to start that easing cycle mid-year, and we see 2 rate cuts happening. So more of a recalibration than an aggressive, rate cut cycle.
So we also had retail sales came in a little bit weaker than expected. What's your read across there?
Yeah, so the retail sales report, weaker than expected. Looking at some of the details, it was quite mixed. I think there was some categories where we saw some payback. Looking at online sales, for example, they were very strong in March, so they declined in April. And overall, I think what this suggests is that consumer spending momentum at the start of Q2 is going to be looking softer. We came out of March with significant momentum when it comes to consumer spending, and you have that robust carryover that's supporting positive consumer spending. But what it does suggest is that on a month-over-month basis, We've seen somewhat of a downshift, and we think that this is a trend that will continue because consumers are feeling, the impact of elevated prices, higher borrowing costs, and just, a more challenging environment, especially for lower income households.
All right, Lydia, thanks so much. We really appreciate your time today. Thank you so much, Lydia Boussour, EY Pantheon Senior Economist. We very much thank you for your time. Speaking of retail, I was really struck by those Burberry numbers. Now, luxury has been...
Burberry?
Yeah, luxury has been... Certain areas of luxury have been struggling, and Burberry kind of doubled down on that. They had sort of weaker sales, and their outlook wasn't that great for the first half either. So even the high end continues to kind of get dragged down a little bit, which also you find to be a bit confusing.
Well, whenever I think of retail, luxury retail, I think of the Chinese consumer as kind of the swing factor. I wonder what they're saying about the Chinese consumer.
It's always about China, but also pockets of weakness in the U.S. As well. So it's not just a China situation when it comes to retail. I'm trying to pull up the
stocks down about 5% here today.
Yep, weak demand China and U.S.
Yeah, so I mean, it's it's out there. It's concerning, but I mean, I guess the overall economic data is still generally pretty solid, I guess. And is it solid enough for the Fed to start pulling back on rates, and if so, when? So that'll be interesting.
And it's still, what I find so interesting is still the hard and soft data. The soft data, I appreciate NFIB was a bit better yesterday, but the feelings are negative, even if the hard data is a little bit positive or at least stable. Particularly if you take a look at how many people are benefiting from the equity rally. Right. And there was a great, in John Arthur's piece, he really helped break it down. Oh no, it was Lu Wang had a piece where she broke it down and said just X amount of people have money in the stock market that are benefiting, and guess what? They're mostly older white people. And everything else is a bit dicier. It was a great piece. You should definitely check it out.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business and economics through our lens of our Bloomberg Intelligence analysts. They cover about 2,000 companies and 130 industries worldwide. We also sometimes take you outside the Bloomberg Intelligence world to those that work on the street. And for that, we're going to go to Shor. She covers senior equity analyst over at Columbia Threadneedle Investments. They have a great team over there. We love talking to these guys. Let's get breakdown after retail sales. Thanks for joining us, Mari. It's great to see you.
Thank you so much for having me.
So break down two things. One, where in the retail world makes sense? And two, do equities at record highs make sense?
Yes, it's a great question. I think, when we look at the retail sales print today, I think we see more of what we've been discussing, which is still a choiceful consumer, still spending more on services over goods and needs over wants. So overall, my outlook for spend on more discretionary goods is more cautious. We still see things like home and electronics really weak. Versus strength in certain channels like e-commerce and value retail, and in certain categories. Like I thought today in the retail sales print, the improvement we saw in apparel was interesting, and we've seen some new trends in apparel, and it seems that some of the traditional apparel companies are taking share back maybe from some of the athletic apparel companies. So that's, I think, an interesting trend to watch. In terms of the valuations on some of these names, it definitely seemed like the group was a little overextended in the earlier part of the string following the rally that started in October. And now I think you really need to be selective. So I would say we're still willing to pay a premium for consistent quality growth that we see in names like Walmart and the off-price retailers, which are all gaining share right now. I think, given the relatively weak demand backdrop, we are willing to pay more of a premium for those retailers that are taking share.
All right. Usually we chat with you via Zoom, so
yes,
it's nice
correct.
to have you in our studio. You usually up in Boston, right?
Yes.
Yes. Okay. Very good. Coming down to the big town. Okay, Mari Shor, you cover the equity space for Columbia Threadneedle. We got Walmart tomorrow,
yes.
And people who like me who don't follow the retail space, I look to that name as kind of a barometer for how the U.S. consumer's doing. What are you going to be looking for tomorrow?
Well, I think we're likely to hear from Walmart still a more subdued tone on the consumer overall. You know, their core lower income customer is still under pressure. They are, however, taking share across category among higher income consumers. And that's been something they've been talking about for several quarters now. So I think that says a lot about the overall consumer and, you know, how they're looking to save money.
Are they taking share from then like Target and stuff like that?
I think they are, yes. Across category, you really see it from Target and others. And I think that consumers are really looking to stock up, you know, and do that one-stop shop at value retailers. You know, you see it at Walmart, you see it at Costco, right? Their results have also been extremely strong. So I think that the results from Walmart tomorrow will show us what's happening from a macro level. But again, I want to be mindful that any strength that Walmart does show, I think is likely to reflect not just what's happening at the category level, but what's happening in terms of their share position within categories.
So how about the dollar stores? What happens to the dollar stores when the lower end of the economic environment is in fact struggling? They are dealing with inflation. Does that benefit their business or does that hurt them even more?
Yeah, it's sort of mixed. I would say it does hurt their core lower income consumer. And you've seen all the dollar stores talking about weakness in their discretionary business among that consumer cohort. However, there is the potential for them to capture that trade down from a higher income consumer. And so that is an opportunity, I think, for the dollar stores, for off-price retailers like Burlington and Ross stores. Yeah. But again, I feel like Walmart has really been the name among those value players that has captured the most share from that higher income consumer.
Also, some of the dollar stores are just a disaster in terms of like shelf stocking, in terms of employees. Like it's a real mess. Like it might be good to get a deal, but only if you actually find a product. John Tucker, why are you laughing at me?
The one next to me, and I loved it, just they closed up. I walked in one day and it was gone. It was just like, what happened? Like overnight.
And
they
crazy.
only had one employee in a pretty large store, and it was just like, oh, you want to steal something?
Pretty much go ahead. Like that, and we can't do anything
care?
about that. So I don't know if you guys know, if we've talked about this, that I am the counter indicator for retail.
Right.
So Mario, so here's the deal. So I only shop on sale. Yes. Period. I will not ever pay full price. So usually where I'm shopping, the joke is that I'm an indicator for what stock you want to short, because I'm only going there because the deal is really good. And it's an inventory thing. So I definitely went over budget this weekend. I went to Nordstrom Rack, but I was buying work clothes, so I felt okay about it. Am I an outlier here? Like, are the discounters going to win or are they going to lose? And how much will I be spending for the rest of the year?
Yeah, no, I think, and again, we saw it in the retail sales data today in the strength in the general merchandise category. I think all of these value retailers, whether it's the mass players, the off-pricers, the dollar stores, the clubs, they will all continue to take share in this environment. In terms of the, in the hunt for deals, I would say I would expect more modest deals going forward, only because, last year we saw inventory much better controlled, much more closely aligned with sales, and all of the retailers are really focused on protecting margin. So I think you will see lower markdowns going forward. Of course, the retailers will always use promotions to drive traffic, but in terms of those major markdowns that you may be looking for.
I'm like a 75% kind of girl.
Yeah.
Like, I don't do the 10,
Probably
20.
won't see as many of those going forward.
That's definitely going to hurt a little bit there. Yeah, we went to, this is anecdotal, obviously. Went to TJ Maxx, which is usually my go-to store. Inventory was horrific. There was nothing. That was really surprising, and I wondered if they're waiting for a cycle to come back, or if they're just really good at getting stuff off their shelves.
Interesting. How about, I'm just asking for John Tucker here, the luxury sector. Alex and I were just talking about Burberry, some disappointing numbers. I thought luxury was kind of a relatively area of strength for retail.
Yeah, I mean, I would say over the past year or so, we've really seen a slowdown among, I would say, both the true luxury segment and that more aspirational luxury segment.
That's more Ryan.
Yeah, and I think it really reflects, those consumers now spending again on things like services and travel. And so we've seen, there's not a lot of public retailers at this point in the true luxury segment in North America, but we've definitely seen a slowdown really globally, across China, Europe. And I think it's that customer spending in other categories, and also some of those brands that do have exposure to the wholesale channel where, all of the department stores still managing inventory very tightly. So if you're selling into that channel, you may also see pressure on
Burberry
your orders.
Is in that business, and they did call that out. That
yeah,
makes
so
sense.
I think it's really a combination of those two things. I think long term, luxury is still well positioned, but we're still kind of coming off of this period of, excessive growth that we saw during the pandemic and watching demand normalize.
I don't know, man. $2,600 for a raincoat? Please.
Well, what kind of raincoat?
Burberry raincoat.
that's
I appreciate that's aspirational, but hell no. That just feels like a waste of money. But
don't you have some budget for clothes?
Oh, yeah. So I give myself a budget of 100.
No, I mean, doesn't Bloomberg clothe you?
Oh, yeah, but not a trench coat.
Oh, okay.
And that definitely would not be in the budget.
Wait a second.
For that.
What?
They have a budget for wardrobe.
Again, another benefit I don't realize.
Another benefit
Yeah.
you don't have.
I
No
mean-
makeup, no.
They don't send me to travel.
They
They
don't-
don't buy clothes
Okay,
for
A,
me. No
we would
makeup.
put makeup on you. You don't let them be, I don't know. Yeah, downstairs is a wardrobe room. We get our clothes picked and everything.
Really? I didn't know that.
Yeah,
Okay.
they don't shop on sale, but, I do.
All right. Mari Shor, thanks so much for joining us. Mari Shor, Senior Equity Analyst. She covers all the retail space, one of our go-to voices for retail. She's at Columbia Threadneedle Investments. They're all over the place. I first hit Threadneedle. They're in London. Then there's been all these mergers with the asset managers, and now it's all under Columbia's.
And they're good. They got some serious talent
They
there.
did.
Yeah.
They're good up in Boston. But she joins us here in our Bloomberg Interactive Broker Studio. Maybe she's walking up down Fifth Avenue and Madison Avenue, kind of checking out the stores. That would be my guess.
Let me know what their sales are.
Yeah, exactly.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We bring you all the top news in economics and finance. And with the help of our Bloomberg Intelligence analysts, they cover 2,000 companies and 130 industries all around the world. We also bring you the view from the street and sort of what do you do in this market when you're at record highs and the direction is higher? You just buy the stuff. You buy stocks, you buy bonds, you sell the dollar. That seems to be the trade. Let's get the trade with James Demmert. He's Chief Investment Officer at Main Street Research. He joins us via Zoom from New York. All right, James, do you buy at a record? Simple question.
Hi, Alex. You do. I think you do. I think investors have made a huge mistake for the last few quarters of just waiting for something to break before they buy, and it's been a mistake. I think it's going to be a mistake going forward.
So what do you buy, James? Let's take it to the next level there. What do you buy here? Do I just load into my big tech stocks that have worked so well for me over the past couple of years, or do I try to get a little creative?
Well, I think that investors, a lot of investors are focusing on the wrong thing, which is the Fed, and they should be focusing on what's driving this market. It's what this market's doing. It's discounting this new AI tech-led business cycle in bull market. And so when we think about what to buy, even at levels like this, we want to think, well, if this is the case, AI tech-led biz cycle, it's going to be productivity growth and fast-growing earnings. Where do I go for that, right? There's 10, 11 sectors in the economy. And if rates stay where they are, which we think they will, you want to go to tech for sure. You want to go to telecom. And everywhere this AI productivity growth can affect, I think healthcare is definitely one of those. I think the utility sector is sort of interesting here, very inexpensive. Yeah. Industrial companies, financials, right? Jamie Dimon saying a few weeks ago how AI is impacting JP Morgan. So I think you kind of want to think about this as a la 1990s, if you will, where that's the last time we had this huge boom of productivity growth. That was a different technology, obviously the internet. Now we're in the AI phase.
Something to say on that, because 1990s didn't always end well on that end. But before we get there, for utilities, I find that so fascinating because usually you think of utilities as just a straight up dividend yield play, right? Are utilities a growth sector right now? Can you play it and value it like a growth sector?
Yeah, Alex, this was my grandmother's favorite sector because it had
exactly.
no volatility. right, predictable dividend yield. But here you have a different story, right? If it's an AI tech-led business cycle, particularly with EVs, and you've got these AI chips just churning away, needing so much electricity, we're looking at the utility industry as potentially a very big growth area. So the grid is going to have to get way bigger to support what we envision is a 7 to 9 year business cycle led by AI, profit growth, productivity growth. And I'll tell you, not just the utilities, but who's going to build that grid? The industrial companies. And I think that's one of the reasons you're seeing, the Caterpillar tractors and that sort of thing doing quite well over the last few quarters. Discounting, not what the Fed's going to do, it's discounting, hey, this is a new era, a very different type of business cycle.
And James, one of the names you have on your list is Apple, and it's on a lot of people's lists, but it's obviously facing some headwinds, notably China. But one thing that it hasn't yet quite gotten into its multiple is AI. Do you believe the AI, pixie dust can find Apple at some point?
We do. And I think that Apple's on a lot of people's lists as a bearish call. We are absolutely the 180 degrees opposite bullish. And we think they're late to the game. There's no question. And that's frustrating as a shareholder. But as we listen to the conference calls and read the tea leaves of where Apple's going here, and you can see it with their recent sort of partnership with ChatGPT, we think June 11th is going to be a big call from Apple in Cupertino and Cook. And I think they're going to talk about, hey, we're bringing AI to the iPhone. We envision it as a supercharged Siri, like a personal assistant Siri, which is way better than what we have now. Might start with subscriptions. Think about the giant installed base around the world they have. And then it probably is going to force us all to get a new iPhone, maybe in a few quarters to support it. So we are fans, 27 times earnings, neglected, one of those that you want to add here.
Mm-hmm. Yeah, I know. It's like I hate it when my phone just one day is like, we're done here. Take us to the store. We have to get a new one. You also like ASML. Why would that be why do you like that for the AI trade? Like there's tons of those kind of guys that we can start playing with. Why is it that one for you?
Yeah, ASML, we're global investors. We love the overseas exposure, right, from the Netherlands. But this is a company knows no debt. And this is an integral part of what makes an AI chip work, right? So there's just a handful of companies that actually do the design that NVIDIA uses, right? So NVIDIA is buying ASML technology to design and fabricate these chips. So they're really at the beginning of the cycle of making the chips. Absolutely important company to own. Not just a chip maker. They're the ones helping the chip makers make the chips. So very important to be at that front end, the most important company on that end.
How about in the fixed income space, James? Do you guys allocate there, and if so, how do you do so?
We do. A third of our assets under management, we manage about $2 billion, are in fixed income, and our view is the Fed may not do anything. And so here's where you want to say, well, if rates have let's say they peak, but they're not going to go down, you want to go out here in duration. I think it's safe to do that. I don't think the Fed's raising rates anytime soon. I think, in fact, at some point they'll lower them. I don't think it's this year. And so you want to go individual bonds, high credit quality, based on your tax circumstance, either own munis or corporates. I love corporates in a non-taxable account. And, don't feel uncomfortable going out 20, 25, 30 years. Lock that yield in. Make sure no one can take it away from you because, yes, eventually rates will come down and those will not be available. So we sort of ladder a little bit on the short end, tons in the middle, and lots on the long end. Very different than what we were doing 3 or 4 years ago.
Mm-hmm. Are stocks expensive right now? How do you price that in? I mean, there's so many different metrics, particularly when you compare it to, say, the yield you're getting on the 10-year. Some might say, yeah, you're not getting compensated at all. That risk is not priced in. What do you think?
Yeah, Alex, I think people are misunderstanding PE ratios. First of all, when you're at the beginning of a business cycle, PEs can be sort of an illusion, right? Because we look at forward earnings, and that E is underestimated all the time. So it sort of makes the PE seem a little higher than it is. And more importantly, and I think this is the real problem investors are having, is if you look at the S&P 500 or any normal index, you got 7 stocks trading at 35 times earnings, and you got the rest of the market trading at 15. Now, anytime that you have financials at 11 times earnings, which is what's going on today, 11 times is almost historic for financial stocks. and the rest of the market trading at 15. That is a value proposition as we move towards a growing, expanding economy, and one that we view as GDP plus 4%, not GDP plus 2, which is what we had for the last 20 years. So higher growth, 15 times earnings, absolutely. And particularly all these sectors that I mentioned earlier that have not yet been impacted by the power of AI and productivity growth.
All right, James, thank you so much for joining us. James Demmert, he is a Chief Investment Officer at Main Street Research, joining us from New York City via Zoom, so we appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube, so you can go to youtube.com and search Bloomberg Podcast, and that's where you'll find us. All right, let's turn now to a conversation on artificial intelligence. Last Thursday, I attended the Boston Consulting Group Edge Expo in Boston. I had a lot of great conversations with the execs at BCG. One was with North America Chair Sharon Marcil. She speaks with CEOs daily about what they are dealing with their own company. One big issue that keeps coming up, Sharon said, was AI. I began by asking her what questions she's being asked most by CEOs. Let's take a listen.
I speak to CEOs on a daily basis, and I think the good news is there's cautious optimism. If you speak to most CEOs, they see a very, very strong potential, some say infinite potential in terms of AI.
Yep.
Obviously the economy is here in North America is performing very well and creates more stability in terms of capital investment. And I think the unknown is about the geopolitics and our current political environment and how that will all play out. But, you know, in speaking to them, cautious optimism, thinking about AI, how do I scale it? How do I get value out of it? And how do I fund the journey? So looking for opportunities for cost efficiencies.
Well, let's go to that AI, because that's been a topic here today. A lot of smart people we've spoken to from BCG about the AI business, about the ethics of AI, which is something folks really need to think about. But the bottom line is it requires, from my understanding, a lot of investment and over a long period of time, a real commitment here. When you talk to CEOs, do they get that, and are they willing to make that commitment?
So Paul, if you click back a year, we were doing a lot of conversations with boards and with CEOs, and there was a lot of experimentation that was going on, but it was just experimentation. It was use cases, and I think people were learning a lot. Now you flash forward a year, and I think companies and CEOs are thinking, how can I create competitive advantage using AI? And what are the areas I'm going to pick to invest in? Because you can't invest it would be cost prohibitive to pick everything.
Yep.
And so what's interesting is you see some companies are picking what you would consider more strategic aspects of their business. So if you think about insurance, either claims processing or underwriting, core processes which are strategic to really lean into and invest. Some other companies actually have chosen more of a back office route, so really thinking about customer service. How can AI fundamentally transform how we do customer service to make it better and more efficient? So companies are in different journeys. It's going to be expensive, and they have to pick the places which is going to pan out for them and give them real advantage in the marketplace.
And on the people side of the equation, there's concern out there in the marketplace about AI will take jobs. Or if it doesn't take jobs, it's going to require a tremendous amount of retraining. How do the CEOs think about that? Are they concerned about that? Are they willing to make those investments in their people?
I think that's exactly right. So AI is going to change a few things beyond the technology. It's going to change, in many cases, actually organization structure. It's going to change process, end-to-end process, and also skills required. We often talk about the 10, 20, 70, and the 70% of the change is going to be people and change management. If you speak to CEOs, I think they feel like it is worth it. It has to be done in order to stay at the head of the curve and to provide competitive advantage. But again, being choiceful in where you choose to scale, because you can't change everything all at once.
I was mentioning to my young producer that as one ages, one has to really make the commitment to embrace change and be open to change. I'm a case in point. When you go talk to the boards and to the CEOs, is it a tough sell to say, hey, AI, this is an inflection point in what you've traditionally understood to be your tech spend?
I think they understand it. I think they're not as familiar with the technology, but they're pushing themselves to get there, because you're absolutely right. I mean, look, if we look at our own data within BCG, the greatest adoption is with our less tenured people, and the adoption there is very, very high. But I think all of our partners, our most senior people, as well as the CEOs and the board members, realize that they have to get the comfort level and upskill themselves in order to be relevant in the future.
Are there some industries that are maybe doing a better job of kind of leaning into this AI and what it really means in the long term versus some others?
I don't know if it's versus some others. I mean, we're seeing a lot of activity, a lot of interest across all of our major sectors. So really thinking about healthcare as an example. So drug research would be an example, or medical records writing. So there's a lot in the regulatory sphere that can be improved through AI. If you think about insurance, there's an enormous amount of documentation and review. And so in specific areas within each industry and within each sector where there's a lot of documentation, review, those are the areas that are being focused on.
All right, speaking to CEOs, you have to talk about, particularly for your global clients, I would think geopolitics, for better or worse, is at the top of their list or on their to-do list. And you think about what's happening in Ukraine, the Middle East, and you can never take your eye off Taiwan and Asia. Can you plan for it? This is a little bit different world than we had 4 or 5 years ago.
It's interesting. We did more work exactly on that topic last year than we're doing this year. I feel like there was a lot of preparedness and scenario analysis that was done last year. It's continuing to be done and updated. I think many companies are on that journey. And actually, our recent CEO survey showed that 63% actually felt much better prepared for a geopolitical event at this time this year versus last year.
All right, how about BCG in particular? I was thinking way back to my days at the Fuqua School of Business at Duke, meeting with all the consulting companies. A couple things that I remember. They paid pretty well, but they worked pretty hard. They travel quite a lot. How has your business changed since the pandemic, maybe with the advent of some new technologies?
Great question. So, look, it's super important that we travel and that we spend time with clients and at sites. I think the pandemic has also, just like many industries, given us a little bit more flexibility. I think our clients are sometimes very happy to meet with us on video, and we do that quite a bit as well. And of course, like any responsible business, we are trying to lower our carbon footprint. So it's something, as we think about, for example, internal travel, that we really try to manage. So I think it's better than when I joined BCG, but it's still a pretty demanding job.
Still a demanding job. It's still a lot of big MBA pipeline there. So talk to us about just kind of the business of consulting today. Hey, just how's business?
Business is good. So if you look at last year, we actually registered another year, which is 20 straight years of growth in terms of BCG. And I would say in North America specifically, our fourth quarter was our strongest quarter last year. And we're off to a really strong start this year as well. Both in North America and globally, all of our regions are growing and all of our practices are growing. Good. So
does that tell you that the C-suite, the board, has some level of confidence that they're willing to engage with you to make the investment in your types of services because they're looking to do stuff?
That's right. We always say that certainty in either direction, either optimism or pessimism, is good for our industry. What is bad for our industry is uncertainty. So if you don't know if there's going to be a recession, if you have fear but a lot of uncertainty, that's a tough time for our industry. And I think there's greater certainty and energy and CEOs feeling like they have to move. They have to move.
Yeah, I would think with technology that would make it even more pronounced. This whole AI thing, I have to get smart on it really quickly.
Indeed. A big part of our business continues to be cost and resiliency, but a very big part is AI.
All right, that was Sharon Marcil. She is the North America chair for BCG. I was chatting with her last week at a conference up in Boston. And, I mean, her job is basically just to take phone calls and field phone calls from CEOs, their clients, and try to help them with their problems. And she says, boy, it's like every single call is about AI, the types of investments that that their clients should be making in AI, how they should be making those investments. How do you weave the whole ethics thing into this whole AI discussion? But it's certainly top of mind for her and her, all the other consultants up there.
Does BCG feel like they're behind that curve or on top of it? Because just as it's their clients are panicking, I would assume that they don't have all the answers either.
No, they don't. But they have a lot of people there that are spending a lot of time on it, and and the people I spoke to there at BCG were, seemed very well read in, but acknowledged, like you said, way early in the game. But I think one of the key takeaways I had was, you have to put the whole ethics of it first before you spend $1, which doesn't usually happen because usually people are spending on the tech, But you really have to think about how you as an institution, as a company, want to frame this investment in terms of the ethical applications of AI. You have to have a really strong call on that before you put the shovel in the ground. So that's kind of how they begin the discussion with their clients. But again, big dollars being spent, big commitments, that's for sure.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.